Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well, then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. It's hard to not get the bug at some point in time about really investing in real estate, investing in short-term rentals, or just being part of this overall buzz around real estate right now as an investment strategy. And I think as more people are wondering what's going on with the economy, maybe you are looking for places to put your wealth and real estate is on your radar. This episode is for you because today we're talking with Ryan Bakke, who runs the Real Estate CPA firm. He specializes in real estate professionals and real estate investors. And we're going to be talking today about taxes for short-term rentals. So if you're looking at converting your home or your investment property into an Airbnb, or if you just like to have some type of income production on your property, this is the episode for you to learn more about how you can do that and how you can do it in a tax strategized way. So Ryan owns several businesses. He works in the real estate field, and he also owns the Real Estate CPA firm, where he advises over 150 clients on real estate tax strategy. He also creates content and has spoken at large events, advising on his areas of expertise. His core mission is to help people have an impact and change their family tree. I love it. So join me right now in this conversation with Ryan Bakke. Hey, Ryan, welcome to Keep What You Earn.
Hey, Shannon, thanks for having me.
Of course. Can you just introduce yourself to everyone listening and tell us a little bit about you and how you became a CPA? I would love to hear that.
Yeah, that's interesting. So I was always good at mental math, but I was never good at calculus, trigonometry. In fact, I actually had a D in my senior year math class. I almost got held back or had to take a summer class because I couldn't understand that more advanced sort of math, but percentages, multiplication, division made sense. And my senior year of high school, there was a ton of different classes and electives that you can take, and I took accounting. And even though I was a C or B student at best, I loved it. I saw that the job prospects were pretty good for people coming out of school in accounting. And I went to school to study accounting and finance. So in college, I studied accounting and finance. I was actually more interested about the finance side of it because finance is more about making forward-looking decisions based on prior data, and accounting is kind of accounting for the past. But nonetheless, I
Mhm.
did both of them. I actually completed 5 years worth of schooling in 3 and a half, and at the time, I was the youngest CPA in Illinois.
Wow.
I got my CPA just before I turned 22.
Wow. Wait, how did you just help me with that. How did you get your CPA? Because I passed my exams when I was 22 and that was still pretty early, but you have to work for a year, right? Or at least it was when I got mine. So that must have been early for you.
Yeah, in Illinois, you need 150 credits, and I was able to do that in 3 and a half years, and I did actually graduate early, so I knocked out the CPA exam in about 6 months, and then I went to work at Deloitte, and as you know, the Big 4, they work a lot of hours, so I was able to get a year of work experience in, like, 7 months, so that's how I got my
That part doesn't surprise me at all. I think I met my requirement come February for sure.
I called the Illinois Department of Financial Professional Regulation. I'm like, hey, look, on your website it says 1 year of full time or its equivalent. What does the equivalent mean? They're like, oh, well, you could have, work 6 months at this job, work 6 months at that job. I'm like, well, what if I get 2,000 hours in 7 months? Is that all right? They're like, yeah, it works. And so that's how I
Yeah.
got my license.
Amazing. Way to hack the system or get what's the minimum amount of time it will take me from here to CPA? I'm going to make it happen. I love it.
Yeah, and I learned pretty early that I wasn't the smartest person in the room, but if I studied enough and I kind of held myself up to that standard that I could become that person that people look up to, and they're like, "That guy's a tack," smart as a tack. And I still coach people to study the CPA to this day. I have friends and just people that I mentor that are still taking the CPA. So, if you're interested in going into a career, this is a great one, especially for the person who's entrepreneur mindset, like this new CPA, because there's tons of CPAs that are burnt out, older, starting to retire, and there's not enough new ones coming in the pipeline because all the really smart kids, they go to tech or they go to engineering or something like that. And not to mention the 30 some trillion dollars of assets that are expected to be passed on from the baby boomer generation to us over the next 10 to 15 years. It's like a gasoline and a match, pretty much.
Oh, totally. And just one more quick question on your background and sort of your. I wanted to talk about your online presence because this is how I found out about you.
Mhm.
Was your handle at Learn Like a CPA, which I love, by the way. You make a ton of content and you're out there teaching. I want to hear, what inspired you to start showing up on social media and be doing more of that versus just like the client work that everyone's used to seeing accountants do.
What originally inspired me, and I created that account while I was still at Deloitte. What inspired me to create that was that there is just so much personal finance and tax and wealth building knowledge out there that not everybody's getting, and especially at a young age. So traditionally, wealthy people come from wealthy families. And so if your mom and dad didn't have wealth, then you probably were not likely to achieve that. And schools don't teach finance, and then they leave it up to the parents to teach personal finance. But if your parents aren't teaching it, then you're not going to learn it. And so I created a page to teach people. At first, it was everything about wealth building. So just talked about Roth IRAs, taxable brokerage accounts, wealth building. And then as my career progressed in the CPA field, as far as my tax knowledge goes, it's morphed into more of like this real estate presence. But because of the finance degree and just I'm actually a Dave Ramsey disciple too. So I have this background of just personal finance acumen, and I really want to help people kind of know no matter where they're at in their journey.
Love it. And today we're going to be talking through a really timely topic, which is short term rentals. I wanted to have you on specifically because I know you focus on real estate investors and real estate type clients. And I wanted to sort of break down for folks the short term rental, the taxes, what is a short term rental and the advantages of owning one, especially because now it's definitely blown up in the last couple of years. I feel like everyone also has a short term rental property somewhere now. So, can we just start with what do you consider a short term rental, and why do you think it's become popular?
I'll backtrack just real quick. So, fast forward
Yeah,
today, I have a real estate CPA focused firm. We serve over 150 investors. I have two CPAs on my staff. We focus on helping real estate investors tax plan and tax strategize around their transactions. I would say dominantly 60 to 70% of the new clients that I see specifically have short-term rentals just because that's what's been popular lately and for various reasons. So, number one, short-term rentals by far cash flow or make more money than your typical long-term rental. I have a property in Ohio. It might rent out for $1,400 on a good month. This past summer, I made $4,500 a month. And in some markets, you can triple the earnings that you'll get. If not, I've seen people 5x the earnings that they get as a short-term rental compared to a long-term rental. So they've just become pretty popular. Some of them are easier to finance too. So instead of having to get a traditional investment loan, you're talking 20% down conventional or like a commercial loan, you can actually put and some lenders will allow you to put 10% down on a secondary home and be able to use it as a short-term rental. So they're easier to finance. And then I think the cherry on top is you can buy these houses in places that you like to go and like to vacation at. And as long as you don't trip up the rules, which we might get into later, you can, have a house in Florida, one in Texas, one in California, and have those make money and build your family wealth and then still be able to go to them when you go on vacation.
definitely. So, what are some of the key rules around short term rentals from a tax perspective?
To understand that, you have to go back to understanding what real estate professional status is. And so real estate
Hmm.
professional status is this code section where it allows people who are full-time in real estate to so realtors, brokers, wholesalers to use their rental losses that are generated through the tax code and use that to offset their income. So on the real estate professional side, I have let's just say two client profiles. You might have a real estate agent that's making $250,000. As long as he or she's buying enough properties per year, they're able to offset their entire ordinary income, their business income. I also have a client who's a former professional NFL quarterback whose spouse qualifies as a real estate professional. And so while he's kind of news anchor, TV anchor, sportscaster, his wife can qualify as a real estate professional and use the losses to offset his high W-2 salary.
Mm.
So long story short, your doctor, your nurse, your accountant, your lawyer is not going to qualify as a real estate professional because they don't spend all their time in real estate. And if you go to Section 469 is where you'll find the passive activity loss rules. It states that if the average guest stay of a property is 7 days or less, it's not actually a rental activity under Section 469, which means it's treated like a business.
Okay. And what would be the difference in treatment? I guess, like, what's the impact of that?
If it's treated as a rental activity, you need to be a real estate professional in order to take the loss against your W-2, your business income. Because it's treated as a business, you then just need to meet one of the material participation tests in that business in order to take the loss against your W-2, your business income. So I have a ton of high earning clients in their respective fields. They meet the exception and they manage the short term rental. And I would say let's just throw out a household income between 250 to 300 grand and they're buying a $500,000 property, on average they're saving between 30 to $40,000 per property in taxes.
Nice. So you mentioned the material participation test. Can you just break down for listeners what that means?
There's 7 different ways that you're able to achieve what's called material participation, and you can use in any of the 7 tests. Now, there's 3 different tests that we see the most common. This first one is what I call the gold standard. Is 500 hours in your combined real estate activities. So this could be if I had one property, this could be 500 hours in that one property, or if I had 2 or 3 properties, it could be combined between all three. It is important to note that there needs to be a grouping election that's made if you decide to group all three together. It's what's known as a dash 4 election if you're doing short term rentals, and it's considered a dash 9 election if you're doing long term rentals or multifamily. So just throwing that out there. The reason why I call it the gold standard is because if you can prove 500 hours in your rental portfolio, you don't have to keep track of anybody else's time. So oftentimes in short-term rentals, I have a cleaner, I have a handyman for every single property. If I can prove that I spend 500 hours, then I don't need to keep track or keep tabs on their time. If I can't meet the 500-hour rule, the next one that we see is what's called 100 hours and more than any other person. And so as long as I have 100 hours and it's more than any other person, and what that means is if the cleaner has 60 and the handyman has 80, I win because I have at least 100 and it's more than any other person. Even though they have a total combined of more than me, I still have 100 and more than anyone else. And the last one, which is the least common that we see, is what's called substantially all test. So if you perform substantially all of the activity of the property on the property, then you'll qualify. What that means when I've reviewed cases is that you can be the only person to step foot in that short term rental. If you have something as much as somebody come put a lock on it for you, that could disqualify you. Even though it says substantially all, the 2 or 3 court cases that I reviewed where the taxpayer has used this case, the judge has immediately thrown it out because somebody else has been working in the property. So ideally, you could have 60 hours instead of 100 as long as you're the only one doing the work.
Gotcha. So if we're breaking down that you want material participation, right?
If you're short term rentals, yes.
Right. If you had to explain the concept, like I know that the tests exist, but the concept of material participation for those who don't understand that language.
Yeah, so basically, what material participation hours, think of it as, hey, this rental cannot operate unless I put this hour in. That's the litmus test. So, obviously, doing guest coordinations, getting the property set up, restocking the toiletries and the linens, the property will not exist without that. Now, let's say I already have a few rental properties. So, if I go to a conference to talk about short term rentals, like my rental property is still going to operate whether or not I'm at that conference or not. So even though I'm spending those hours in real estate, those wouldn't be material participation hours.
Gotcha.
Same thing with what are called research and education hours. Unfortunately, listening to this podcast is probably not going to count towards your hours. The same way as if you're analyzing new markets. So I already have a property and I'm analyzing another property, it's not going to count if I'm analyzing a different property. Now, if I'm analyzing properties in my market for purposes of seeing where my price is, then that's a different story.
Right. Do you recommend that all folks, let's say someone who's brand new into short-term rentals or exploring it, do you recommend that everyone track their time they're spending in these types of hours regardless, just to make sure they're meeting that 500-hour test?
If you're a high earner and a decent sized purchase price, like the numbers I was throwing around. So let's say, single about 120, 150, and then married, let's say up to 300. Yeah, you're gonna wanna track your hours just because it'll give you the option to do some tax planning. And the strategy is not for everybody, depending on, again, your income, right? So in my short-term rental tax training that I have coming out soon, I show a slide that talks about, hey, here's the green light, here's the yellow light, and here's the red light, as far as like whether or not you should do it or not. And it's really just based
Hmm.
on like a heat chart of, hey, the higher your W-2 or the higher your income is, the more likely you are going to want to do it. The higher
Yep.
your purchase price is, the more likely you're going to want to do it. If you sold off a property in that year, you're more likely going to want to do it. So, for example, I have a ton of clients, and I even made this own transition of they will have two or three long term rentals, just regular run of the mill rental properties. They'll discover this whole short term rental thing, and they'll be like, well, why am I doing that? I need to get out of that, and I need to get into short term rentals. And I'll have clients, whether they're clients with me or they came to me after they already did it, which is unfortunately is often the case, they will liquidate part of their portfolio, have a huge taxable gain, and then want to figure out ways to offset it. And that's where the planning comes in to say, hey, you really want to double check with your CPA or tax advisor before you do a transaction like that, so you can know the implications.
Definitely.
The other important call out is understanding how depreciation is calculated. So every single time you buy a property, it's allocated. The purchase price of your property is allocated between building and land, which means you're not able to depreciate everything. For example, the Smoky Mountains, Tennessee, which is a very common short-term rental destination market. So there's Pigeon Forge, Sevierville, Gatlinburg. There's millions of people that go there every single year. I have to tell you, these properties have shot up in value. I mean, I've had clients that have bought, let's just say, two cabins back in 2017, 2018 for 250 grand. Those same cabins now are worth 800, $900,000. It's absolutely insane. I've had clients who are 100K, 150K W-2 earners who became millionaires just because they bought one or two cabins in that market. Anyway,
Mm.
that type of market, it has very low land allocation, which means the tax benefits are a lot more because it's low land, and you're able to depreciate more of your purchase price. So on $1 million property, let's say, I'm probably going to get $900,000 of depreciable basis for purposes of tax, compared to a market like another common destination market is Gulf Shores, Alabama, or Destin, Florida. In Gulf Shores, Alabama, it's not out of the ordinary to see 50% of the purchase price assigned to the building and 50% of the purchase price to be assigned to the land. So if I'm spending $1 million in Gulf Shores, I'm going to have a lot less tax benefits than if I was to spend $1 million in Tennessee. Now that brings me up to one of my other talking head points is you should never invest in real estate solely for the tax benefits. But this is something that I teach my students and the people, my clients, is that if you are in it for the tax benefits, hey, there's some markets out there that perform really well that are way better for tax benefits than maybe the current market you're looking at.
That's a really good point. And how do you, I mean, without going into like the mechanics, but right, if someone's wondering right now, going, how do I figure out the percentage that I have in land versus building? Like, how do I know that? What do you recommend they do?
Yeah, so that's something that I teach clients and students. The best way to do this, and this is a huge point. Thanks for bringing it up because a lot of times when investors run numbers, they're not thinking of the, okay, once I buy this property, what's going to happen? So like Florida, destination markets are having huge reassessments when it comes to property taxes, insurance, and HOAs and other things. And if you're not accounting for that in your pro forma, oh, the property tax bill is 2 grand now. It'll probably only be 2,500 after I buy it. Probably not. What you want to do is go to that particular market. So if I'm buying a property in Destin, Florida, what I want to do is I want to go look at over the last year. I want to go look at five recent comps, similar square footage, bed and bathroom count. And what I want to do is I want to see how much that property tax bill went up because in almost every single state, property tax are public record. So you can see somebody's name, address, how much they pay in property taxes. And so if let's say I'm buying a property on 123 Destin Way, I want to look at all the other properties that were sold in the nearby area and see how much their property tax bill jumped. And I'll even run like a little average to say, okay, on average, these five properties, they jumped up 23%. One went up 30, one went up 15, but on average, 23%. And then I'll assume that my property tax bill is going to go up by that. I will plug that into my pro forma for my template when I'm running my numbers to analyze the deal. And so not only is it important for figuring out how much is building and land, but it's also important as an investor to know how much that property tax bill is going to go up.
That's such a good point because it's always part of the deal is, well, what is the commitment I'm making to this? Like, what is actually involved in the deal rather than just what's on the purchase price, like what's on the price tag?
I even have in the bundle that we'll link in the show notes, I have a STR deal calculator
Hmm.
that it automatically factors in the tax benefits for you. And so you could go in there and plug in the purchase price, plug in your income level, and I use a base percentage there, and it'll have to change depending on what market you're in. But I give people a good idea of what they could expect to save in tax.
Love it. And when looking at short-term rentals, I know that there are tax advantages, right? Tax considerations. A, what are the tax advantages of owning a short-term rental? And then who should be looking at these types of opportunities? Like by that I mean like is it someone who wants cash flow versus appreciation versus like what their goal is? So who is a short-term rental good for and how can it save them money in taxes?
So I'm a part of what's called the short-term rental super team, which is a group of people who are experts in their field. So we have somebody who's amazing at marketing, somebody who's amazing at banking and financing. We have a lawyer in there. We have a person that's really good with short-term rental data, and then of course there's me, the tax and financial person. And one of the things that we talk about is figuring out what pillar of investing means the most to you. So I have somebody that I'm working with in Jersey right now who wants to invest with me, but he's really focused on appreciation. He'll give up the cash flow now, but he wants appreciation on the back end. Versus there's some people that want cash flow right up front, just cash flow. I need cash flow. I will give away with appreciation. Knowing what your investing pillar is so important. I personally work with clients who are trying to get out of their jobs, who may not hate their job, but they just want the option to be able to leave. And over the past couple of years, I mean, myself included, like I've been able to leave corporate. I've been able to leave my job and do what I love to do because of real estate. And I see a lot of clients where it'll be a high earning couple, and by the time they get their second or third short term rental set up, they have enough to replace probably one person's salary. And so then one spouse is able to leave, kind of go into that full time, and then the other spouse is able to still work. And those are the people that for the cash flow is super important because cash flow means that they can get out of doing what they don't like to do.
Totally. And then tax advantage wise, let's talk about that. Like what are the attractive aspects of short-term rental ownership from a tax perspective?
The biggest one is understanding the difference between earned income and what's called passive income. So there's
Right.
three types of buckets of income, and I talk about this in my training as well as we have a earned or active income. So that's going to be income that you show up to work for. That's going to be the hardest to earn. It's also going to get taxed the most. And on top of that, it's also the hardest to be offset. For W-2 1099 people, the only way you're able to offset your income is you could have 401ks, HSAs, and you can have more babies. That's about it. That's the only way you're able to really offset your tax liability outside of your W 2 job. Now, what I teach people is you want to convert that earned and active income into different vehicles that are going to earn you money passively, but also have better tax benefits. So portfolio income, for example, just owning stocks and bonds and interest, they're taxed at lower rates essentially, and you have favorable capital gains rates. The big thing there
Right.
is it's not subject to FICA tax, which is Social Security and Medicare tax. Which, if you check the IRS inflation, the Social Security Administration is getting an 8% raise this year. Sorry, we're already in 2023. They're getting an 8% raise this year, and then you
Yep.
have passive income, which passive income by default all rental real estate that you own is considered passive. And then any activity in which you don't materially participate in is considered passive. And when I say this, for some people and some clients, this is mind blowing because let's say I wanted to invest in your CPA firm. If I'm passive and all I do is, hey, I'm going to give you 100 grand, Shannon, you run the day to day. I don't make any decisions. All you do is cut me a check. Even though it's an ordinary business, it's a CPA firm, I'm a passive owner, I'm a passive investor. That's a passive activity to me, which means I can use my rental losses to offset my passive income streams. So I'm personally invested in laundromats, hair salons, where I have somebody who's running the day to day. That's passive to me, and I'm able to use my rental losses from my properties to offset that income. So I really teach people how to convert the bag because there's tons of high earning professionals that I work with, doctors, lawyers who are making really good money, 400, $500,000 a year, but they never learn how to convert that income over to different types of buckets that will are very tax advantageous, and they save you a lot of time, right? Running a rental is a lot simpler than like showing up to work every day, in my opinion.
Oh, totally. And you have a little more control over how much you earn as well, because it isn't a steady paycheck, which is kind of the blessing and the curse. But you mentioned too, like you want income to be passive in theory because it's taxed at a lower rate. And I know that's definitely wealth building hacks right here is passive income. But you also mentioned that, well, for it to be passive, you don't materially participate. So for those who may have just gotten confused there and said, wait, I thought I wanted to materially participate in my
Yeah.
rental, and now you're saying I don't. Can you just kind of clarify that for anyone who's listening?
Yeah, so in most years, you want your rentals to be considered passive, which means that you are paying lower tax rates, you're not paying Social Security, Medicare tax, and you have the ability to offset the income with other passive losses. The year that you want to materially participate is the year that you place your property into service. So I just went
Mm,
live on an Airbnb back in May of 2022. I ran the thing. Let's say I'm the one who runs all the day to day stuff. I materially participate. I can capture my tax benefits in 2022 and then go passive in 2023 because I've already milked the bulk of the tax benefits out of that property because I was able to take the losses against my CPA firm income. So
okay.
you want to materially participate in the year that you go live on the property, and then subsequently you want to be passive years after that.
Okay. And for those listening who are thinking, okay, materially participate, he mentioned, okay, I need to spend a lot of hours in the property doing things. Ah, I'll just stay there and I'll live there. Does
Hmm.
that count? Let's talk about if you want to spend time in your rental or you want to rent out the place where you live. Let's just kind of talk about that. If the rental is not in another state or somewhere else and you actually do get to enjoy the benefits of it, what are the rules around that?
For people who are nerds like me, there's a code called Section 280A that talks about what are you able to do in a rental property as far as stay in it for yourself. And so what that basically says is there's a rule, and you know you're in the tax code when a sentence starts with lesser than the greater of.
It's a language thing, not just math, guys. You have to like go, wait, what?
But everybody gets 14 days or 10% of the fair market rental days, which means I place a property in service in May. Between May to the end of the year, I get my 14 days, no questions asked. If I rent that property out for, let's say, more than 170 days, I would get 10% of 170. I would get 17 days instead
You get to stay in the property for that amount of time, is what you're saying?
without losing your tax benefits. Yes.
Got it. Okay. So you can stay for up to 14 days or up to 10% of rental days.
That's right. Now, the Congress does not want to give you deductions for a property that you're getting personal use out of. And so
Right.
if there's elements of personal use in your property, they're going to limit you to the deductions that you're able to take. It's important to note that a day in which you spend 4 hours at the property working does not count as a personal use day.
Okay.
So for people who are worried about staying there too much, working there, and accounting towards their days, if you work there for at least 4 hours a day, it doesn't count as a personal use day.
What would count as a personal use day then?
If I took my family there and I didn't work at all, or
Okay.
if I told my friend, "Hey, I got this lake house. You can come stay. You can come crash at it. I'm not going to charge you." That's actually a personal use day too.
Gotcha. So basically charge your friends rent.
Yeah, fair market rent. Yeah.
Exactly. So, what other tax deductions or strategies do most people miss out on because they don't know?
Yeah, so I think the best place to start is actually pull up the where real estate's reported, the Schedule E of the 1040, and just comb through all the line items. There's advertising, certain costs, there's cleaning, maintenance, utilities, insurance, taxes. There's a lot of costs that show up right on that form that I see people miss. Some of the other common things that we see people miss is especially like a lot of startup cost. So people will spend money on these tools that help them analyze where to invest at, or they'll spend money on what are called PMS, the property management softwares that allow them to run the property that they're not accounting for. Oftentimes too, I run my stuff from my laptop and my phone, and I'm able to expense a portion of my data or my phone usage towards the property. So maybe I spend, 5% or 10% of my time on my phone managing my rental. I'd be able to take 10% of my phone bill in that case. In that bundle that we'll link in the show notes, I have all the expenses listed there, and then as well as ones that I commonly see miss.
Okay, perfect. Let's talk about that for a second because I hear this all the time, even from CPAs. How do we know a short term rental is something that we put on the rental schedule versus a business on the Schedule C? Because I think there's a lot of this back and forth of is it a Schedule E or a Schedule C rental?
If you look at publication 527, they came out a while ago and said that short-term rentals only go on Schedule C if what are called substantial services are provided. So substantial services include things like cooking, cleaning while your guest is staying there. So the typical Airbnb, even though it says bed and breakfast,
You're not showing up with breakfast.
yeah,
Yeah.
no. So the tip, I mean, in my case, I think this past year I only had maybe 2 properties end up on a C, and that was because the clients were, doing, like, safari-like activities and kinda cooking and doing exhibits for the guests, but your short-term rental is not gonna show up on Schedule C unless you provide those substantial services. The key thing there is if you provide those substantial services, you are going to be triggered with self-employment tax because it rises to the level of a trade or business. I don't see this quite often because people don't want to incur the additional cost for that anyway. So you're not seeing people go out there out of their way to like, provide the bed and breakfast or to provide this or because it costs a lot more money. That kind of created some confusion as far as like, hey, can an activity be on Schedule E and not be subject to the self-employment tax also? And so they released last year a chief counsel memorandum. I don't know the number off my head, but that basically said that, hey, look, property can be non-passive as a Schedule E without triggering the self-employment tax, and that's the biggest thing that we got out of that.
Very interesting. So, Ryan, where can folks learn more about this if they are in short term rentals or thinking about getting into them and they're like, wow, this is a lot of information and I definitely need to learn more about what this all means for my tax situation? Where do you suggest they go?
Yeah, so there's a lot of, I would say, bad information online, and you have to figure out like where's the good information at. So I run a Facebook group called Tax Strategies for Real Estate Investors. We have over 4,500 real estate investors in that group, and I'm posting content probably weekly. But more importantly, a lot of people are just asking questions, and that's what's important too in these communities is that if you have a question, odds are somebody else has the same or similar question, and so by you asking it in their group, it kind of benefits everybody because everybody can see that response. I also, I have my Instagram, Twitter, I have my podcast, the Learn Like a CPA show where I'm releasing podcasts every other week. And they're very specific and diving deep on one certain topic. So you won't ever find a podcast of mine to be more than 15, 16 minutes because it's very short, descriptive, straight to the point. And I want to leave it to you to be actionable. So I want somebody to be able to listen to that podcast, take a few notes, and then go do what it is that I'm trying to get them to do. And then lastly, we have the bundle in the show notes, but I'm putting on a short-term rental tax training, and it's coming up very soon. So it's going to be middle February launch, but it's going to be A to Z, everything you need to know about real estate tax, specifically if you're in short-term rentals. So this course, when I created this course, I had the mind of somebody who's an investor, but for right now they're just focused on short-term rentals. So we're covering A to Z, all the things you need to know about real estate tax strategy. So I talk about those different types of income buckets. I talk about what expenses you can take. What are some of the common strategies for short-term rental investors while they own it? And then we also talk about, well, on the back end, when you're ready to exit, what are some ways that you can exit tax efficiently? And whether it's you're done with real estate in general, or you want to parlay that investment into something different. And so in this training, it's A to Z, it's covered. And what I'm offering people who go through the training is if you go through this training and you still have questions, you can feel free to reach out. I will happily answer anything that you have that's outstanding.
Perfect. And we'll make sure all of those are linked in the show notes. Ryan, thank you so much for sharing everything you know with us today about the short term rental market and tax advantages, because I know this is something that just confuses everyone and it's just nice to see it broken down.
Yeah, thank you for having me. It's been awesome. Again, guys, if you want to reach out, it's just learn like a CPA. I look forward to hearing from you guys.
All right. Thanks, Ryan.
Thank you.
Did you enjoy this episode but want to explore more on this topic? Or maybe you have questions for me and our guests. One of the best parts of doing this podcast is interacting with you in the Keep What You Earn community. This community is a completely free resource for you to ask questions, chat about our episodes, and to connect with us on our monthly calls. Yes, all for free. We host this community on a platform called Circle, so you won't be bogged down by Facebook notifications or get your posts buried in the mix. So click the link in the show notes to join us in the community right now. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.